Let's understand the competitive structure of the market as per Michael Porter. He proposes four different types of competition. One is threat of new entrants, bargaining power of the supplier, bargaining power of the buyer, and substitutes. Threat of new entrants will be less when the entry barriers are high. What are the entry barriers? Like if the cost of installing setup for producing the product is very high, that is the cost of manufacturing, then new entrants would not like to come. For example, in the, oil and gas companies and defense production. And if the economies of scales are involved, it means by producing higher quantities, then only the profit is made. In such cases, the existing companies may already have established the economies of scale and they will have an advantage. If the existing companies have brand loyalty, then also there will be a problem for the new entrants. And usually, the existing companies will have a very strong hold over the distribution channel. The rivalry between the competitors will be very high if there are a very large number of competitors, and if the growth in the industry is very sluggish, and if the fixed costs are very high, and there is over capacity in the market, and if the exit barrier is very high. The threat of substitute products will be high if the substitute companies will be able to produce the same product at a lesser price, or if the switching cost of the buyer will be low. It means if a buyer will be able to buy a new product at a lesser price easily, then also the threat of the substitutes will be high. Also, if the new company which is producing the substitute has got the capacity to buy out its suppliers, then also the threat of substitutes will be there. Now, coming to bargaining power of the supplier. See, bargaining power of the suppliers are high if the suppliers are very less, and there will be lack of substitute material the supplier is supplying. And finally, if the switching cost from one raw material to another raw material is very high, then also the threat of supplier will be there. Also, if the supplier has got the capability of forward integration, it means if the supplier can buy out the new company which has already coming, then in such case also the threat of supplier will be there. Now, coming to the bargaining power of the buyers, if the switching cost is less, the buyer will move to the other product. Hence, they will have the high bargaining power, and the buyer will may have the capability for backward integration. It means the company has got the capability to buy out its suppliers, then also the bargaining power of the buyer will increase and it will be very high.